This is your AP Macroeconomics review video for Macro Unit 3, Aggregate Supply and Demand. So just as a review, we talked about how there is a classical dichotomy theory, which is basically that over time, changes in inflation mean that there is a difference or separation between real and nominal variables. Remember, the difference between real and nominal is that real variables have been adjusted for inflation. So if you adjust for time changes in prices, then your inflation over time is only going to affect real variables and not nominal ones, because nominal ones use whatever current prices and current quantities that are existing at the time period. Because of this, there is a suggestion or a theory that monetary developments, meaning changes to prices or the printing of money or things that affect how much spending is going on, only affect nominal things and not real ones. So this is also referred to as monetary neutrality. That changes to the government's money supply, so how many dollars are in circulation, do not affect real values of things, only the nominal ones. So if we were to double the money supply, that would cause people to spend more money. That means prices are going to rise, and ideally they would also double. But remember, your wages will also rise over time, and although wages happen to be sticky, they don't rise immediately when prices do. They eventually have to rise because people cannot have low incomes and then afford to pay high prices for things. So remember, this time period where your income has stayed the same but prices have gone up is what we refer to as the short run. The long run is a time period when wages have adjusted to the new higher prices. You also need to know how to draw and correctly label an aggregate supply and demand graph. So remember, you're always going to need a title. For aggregate, that's going to be the country that you're talking about. The vertical axis has to be price level or PL. The horizontal axis is Y, which stands for real GDP. Remember, your horizontal axis also is the same as output, so you could see that terminology. It's also the same as employment or national income. The vertical line is long-run aggregate supply, the upward sloping line is short-run aggregate supply, and your downward sloping line is aggregate demand. This particular graph here is what we call in full employment equilibrium, because your X of short-run aggregate supply and aggregate demand is right on top of the long-run line. But that X can be to the left of the vertical line, which means we're in a recession, or it can be higher or to the right, which means we're in a boom period. The aggregate demand line is downward sloping, and any downward sloping line means that there's a negative relationship between the two axes. So in this case, that's price level and real GDP output. As prices go up, people purchase less goods and services, and as price levels go down, people purchase more goods and services. So at a lower price, you have more total output bought, and at higher prices, you have less output bought. Now, there are three reasons why the aggregate demand line shifts or slopes downward, and these are all related to CIG and NX, which is consumption, investment, government, and net exports. These are the four categories of GDP, and of course aggregate demand is spending, and these four groups of people are the people who spend their money on American-made products. We typically assume that the government has a fixed government policy in which they spend what they are planning, what they have planned in Congress, and they do not overspend unless, of course, the question is telling you that. Otherwise, we assume that the government has pre-planned and passed a law that says what their budget is, and they're going to stick to that. So generally, we're looking at changes in consumption behavior, investment, which is business spending, and net exports, which is foreigners buying American-made products. The three things that show why aggregate demand is downward sloping are, the first one is the wealth effect, which is the relationship between price level and consumption. As price levels rise, ceteris paribus, which means everything else stays the same, including your income. We're now in this system where your income has stayed the same, price levels go up, which means your real purchasing power is lower. because the money that you have does not buy as many higher priced things. So real wealth is smaller. That makes people feel poorer. And so therefore, when they start to realize they don't have enough money, they start to spend less. So consumption goes down. That leads us into the interest rate effect. So if we have the same assumption that price levels have gone up, we've already been through the wealth effect. So people have started to limit their consumption. This would mean that if you have to pay the same amount of bills or buy the same amount of groceries and medicines for your family, you now need more dollars than you did before because prices are higher. So to get those dollars, some people decide to sell off their assets. This could be removing money from their savings account, selling off stocks and bonds, or selling other types of properties that they have. But anytime somebody goes to the bank and removes money from the bank, let's say you liquidate your checking, you take money out of your savings, you sell off your bonds, you cash those out. As you remove money from the bank, it causes the interest rate to rise because the bank needs to incentivize people to put some money in. Why are we incentivized to put money in the bank when your interest is high? Because you earn interest on a savings account. So people are feeling poorer, so they right now are removing money from the bank. The bank needs to try to slow that down, and so that's what causes interest rates to rise. Now, the downside to interest rates rising is that people who need to borrow money, which tends to be businesses, that is going to increase the interest that they have to pay on loans. And businesses and investment does a lot of their business based on loans. So this would increase that. It would also slow down the amount of investment spending that we have in the economy. This leads us into the exchange rate effect. So when interest rates rise, from a foreign perspective, they don't have this weird, situation with stagnant wages while prices have risen. So to a foreigner, American interest rates are just higher than they were before. And that means that buying an American bond in the United States would be very lucrative, or at least better than it was before. So that means US bonds are going to be more attractive to foreigners who have extra money to save. So foreigners are going to convert their money into dollars, and then they're going to go ahead and buy American bonds or, put money in American stocks. As they do this conversion of their currency into US dollars, that means the US dollar is more in demand, and that is going to cause it to appreciate or rise in value. Just like the demand rising for any good makes its price go up, that's exactly what's happening to the US currency. Now, as the US dollar appreciates in value, the downside is that means American-made goods and services that we typically sell to foreigners are going to be more expensive. So even though we're selling more bonds and stocks to foreigners, we're going to sell less goods and services as exports to foreigners because they're going to be more expensive than they were before. So these three things, wealth effect, interest rate effect, and exchange rate effect, are explaining why aggregate demand is going down. As prices rise, people can't afford to buy the same amount of goods and services, and therefore real GDP drops. Aggregate demand shifters. Aggregate demand is always about spending in the larger macro economy. So anything that affects spending, it could be consumption, investment spending, government, or net export spending, is going to shift aggregate demand. To the right is an increase in spending, to the left is a decrease in spending. Now, anything that would also affect how much you can spend would also shift demand. So it could be changes in expectations about the economy. Sometimes when consumers or businesses are really happy with what's going on, they tend to plan for beneficial things in the future, including spending. And if they're a little concerned that the economy is going to slow down, they get pessimistic, then they're going to start saving, which of course is less spending. Anything that would affect the amount of wealth somebody or a business has is going to affect how much you're spending. So if you made a lot of extra money this year, or you did well in the stock market, those things would increase spending. If you lost a bunch of money, or a pandemic happened and you lost your job, those things would decrease the amount of wealth people have. Now, based on the economy, of course, the assets that you have, like houses, can also go up or down in value, and that can also affect how much wealth you have. Businesses also do some of their spending based upon the existing capital stock. So if there is solid infrastructure there, then firms can come in and set up shop or build a factory much easier and cheaper than they could before. If nothing exists, then they have to build the infrastructure and then the business as well. So depending upon what types of existing capital stock are there, that can also affect investment spending. And we've also talked about ways the government can incentivize spending, and that's fiscal and monetary policy. So fiscal policy is Congress, and Congress gets to decide how much government spending we're doing and what our tax rates are. Monetary policy is controlled by the government's central banking system, and they control how much money or currency is printed and in circulation. And they also do the buying and selling of American bonds. So fiscal policy is taxing and spending by policymakers in Congress. It can be expansionary, which is an increase in government spending, or a decrease in taxes, and that would increase aggregate demand. And you can also contract fiscal policy, which would be the opposite, a decrease in government spending or an increase in taxes. Those things would shift aggregate demand to the left. Monetary policy is the central bank's use of the money supply. It also can be expansionary or contractionary. So if the government decides to increase the amount of money in the supply or print more money or do other things that would create money circulation, that would be expansionary. That also lowers the interest rate. To contract the economy, then the government would want to decrease the amount of money in circulation, thus increasing the interest rate. When the interest rate is high, people save their money, so they're spending less, and that's what contracts the economy. If there is an increase in the money supply, the interest rate is lower, and therefore we're incentivized to borrow and spend more. Aggregate supply is typically upward sloping for the short run. And remember, the short run is a time period where wages and prices don't match each other. You can generally think of it as a period of 1 to 2 years. Now, anytime your wages are, let's say, low and prices are high, it's going to affect how much money you can buy with the money you have. A long run is a time period where everything is caught up to each other. Now, there's two theories as to why the short run aggregate supply is upward sloping and the long run aggregate supply is vertical. Remember, wherever your equilibrium is the expected price level. So businesses are going to plan accordingly. This is the price level that's going on. We are going to try to plan for how many goods we should buy, how many we think we can sell at that price. Remember, businesses are in competition with a lot of people, so they don't always have control over their price. The market sets the price, and businesses can't necessarily control that, or they're going to lose a bunch of business to their competitors. So businesses look at what the market is pricing at, and then they decide to build their business around that. How many employees do I need to hire? How many goods do I think I need to purchase and sell? So all of these problems exist when the price level deviates from what was expected. And let's say that the price level turns out to be higher than what they expected. A higher than expected price level means that your equilibrium is going to be on this higher end of the SRAS line. And that also means that it's going to be more profitable for you because you were willing to sell the price here at PLE, but now it's higher than that. So you're going to have a bigger profit margin. That's really beneficial for the business. So you want to sell more goods at a higher profit margin if possible. Now, if the price level turns out to be lower than what you expected and lower than what you were planning for, somewhere down here on this lower red portion of the SRAS line, now your profit margin is super small or smaller than you were planning on it to be. So you might not have enough money to sell a lot of extra products. So the amount of output that you're going to create is going to be smaller than what you expected. Now, there's two theories as to why this upward sloping line happens in the short run. The first one is sticky wage theory. Nominal wages that businesses pay their workers do not immediately adjust to price level changes, partially because the firm does not know if prices going up or down are temporary or they're going to be a long-term change. So you don't want to give everybody a raise one day and then have to immediately revoke it the next. So they want to wait to make sure that price level changes are going to stay that way. And when they realize that that change is becoming the new expected price level, then they're going to alter wages. Now, sometimes businesses can't alter wages because of contracts. So there are lots of workers who work on contracts, and that is a legal document saying somebody is required to be paid a certain amount during the life of the contract. And keep in mind, there's also just, social reasons. Businesses and certainly managers would rather give people raises than cut their pay. People tend to work really hard in order to get a raise and to keep a raise. But then if the business keeps going back and taking away your increase in pay, then workers can revolt or slow down, not be as productive, and be upset at work. So that can really harm productivity. The second theory is sticky price theory. And remember, businesses are in competition with lots of other businesses. So even though the general level of prices is rising, doesn't mean that every business raises their prices at the exact same time or by the exact same amount. So one of the things that determines how much they raise would be menu costs. This is the cost of adjusting prices. Because if you are going to sell your goods and services to people at a different price, you have to actually incur a cost to do that. So a restaurant would have to print new menus. That's going to cost them money. And it's always easier and cheaper for a business to put things on discount rather than raise prices. So because of this, some firms keep their prices relatively low for as long as possible before they raise them. Whereas other people, if it's very cheap and easy to raise your prices, then you might do that immediately. So the short run aggregate supply line can also shift. And of course, a shift to the right along the horizontal axis is an increase in supply. And you can also shift your SRAS to the left like I did here. This is a decrease in supply. The things that shift aggregate supply are anything that affects the production or making of goods. So these are your input costs, also referred to as factors of production, land and all natural resources, labor. Labor can be literally how many people are working, how many hours they work, or it can be things like the knowledge and training of the workers. Capital stock is existing infrastructure, equipment, machinery, technology that businesses use often. Obviously, technology. Entrepreneurship is ideas, things that people want to invent. Sometimes you'll hear the term commodity prices. Commodity is just an input that businesses buy in bulk. So, that is basically an input, and it could be technology or it could be capital. If the commodity or input prices rise, they're more expensive to buy. So that would lower the supply that can be created. And if the prices are cheaper, then you can increase supply because you can buy more of this particular input. Other things, businesses are the ones who pay nominal wages to their workers, and that is an input for the business. So if you're going to increase your workers' wages, that would be an increase in input costs, and that would cause aggregate supply to shift to the left or go down. A decrease in nominal wages would increase aggregate supply. And then, of course, changes in productivity. This is literally how much supply each worker is producing with each hour that they're working. So if they're increasing productivity, they're literally increasing supply and vice versa. The long run aggregate supply curve is vertical. And it's vertical at the natural rate of output, which is also referred to as full employment or potential output. This is here Y sub N. N stands for the natural rate of unemployment, which is different for every country. In the United States, it's around 5%. Another country, it could be around 9 or 8%. But, generally, if you get a free response question that's got kind of a made up country, the natural rate of unemployment is where you kind of should be. And whatever their current unemployment rate is, whether that's higher or lower, can determine whether this fake country is doing better or worse than their natural rate. So for the United States, it's around 5%. Now, why is the long run vertical? It, of course, is also a supply line, so it is dependent upon land, labor, capital, and technology, just like the short run supply. But the long run is a time period where wages have risen to meet price level increases. So if prices went up by 20% and your income went up by 20%, then you are spending the exact same amount of money or purchasing the exact same number of goods as you did before, just you're doing it at a higher price and you can afford that because your wage has gone up. So the amount of output that needs to be produced by companies is the same. The only thing that's changed is price level, and we of course call that classical dichotomy or monetary neutrality. Now, over time, over long periods of time, we have significant growth in the economy. The U.S. is a pretty strong economy, and we've got a lot of good things going on. People create and invent products, and we have really good entrepreneurship. So if this is the economy in 1980, and why 1980 is the amount of goods and services we're producing, well, over time, people invent things, and we've got new products going on. We have new jobs that are being created as we move into 1990 and 2000. That also means that demand for those goods are going to be rising. And therefore, over time, we have increased price levels and increased output in real GDP. And this is what's going on over periods of 10, 20, 30 years. The long run aggregate supply is like looking at climate, whereas the short run aggregate supply is looking at the weather today. So over long periods of time, yes, the long run aggregate supply does shift. It just shifts so slowly because it's really a long-term average of what's happening in the short run economy. Now, the aggregate equilibrium between short-run supply and demand can also be changed by supply shocks. And a supply shock is just a shift in the short-run supply line. And this, of course, can be positive or negative. So a negative supply shock shifts supply to the left. That causes stagflation. Stagflation is a time period where you have higher price levels and lower output. That also means that if output is lower, you have higher unemployment. So those are two really bad problems that you can't solve at the same time. So if you have some type of adverse event like oil prices rising, oil is extremely important to the United States' economy because it is used to produce gasoline. So if a major natural resource like this has a steep rise in its price, that's going to cause input prices to rise. Supply is going to shift to the left. At our new higher price level and lower output, we've got stagflation here at point B. That's really bad, and there's no great ways to solve a stagflation economy. We can, of course, being a free market, do nothing. If we do nothing, demand is going to fall. Because prices are high and people are unemployed, that means they're not going to be able to spend money. And then, of course, if supply goes down and then demand goes down, long run is going to go down too. So this whole graph is going to shift to the left for a certain time period, which is going to be much longer than most people want to be unemployed in a bad recession. So if they do nothing, this is just kind of a wait and see, and we could be in a long recession. That could be a 10 or 15 year recession or even more, depending on how bad it was in the first place. The other options are that the government could step in to try to make some type of change. And we know that the government can use either fiscal or monetary policy. And both of those things can either increase aggregate demand or decrease it. Now, typically what happens is they want to increase aggregate demand because that would fix your unemployment problem. You put people back to work, Y goes back to YN. The downside is that inflation gets even worse when you do that. But remember, people who are unemployed tend to vote, and so policymakers in Congress who are publicly elected tend to want to solve the unemployment problem and deal with the inflation problem later. They could also force aggregate demand to the left. That would, of course, solve the inflation problem, but make unemployment worse. There can also be demand shocks that affect the aggregate demand line, and these also can be positive or negative. So during the Great Depression, of course, we saw a collapse of the banking system, and that, of course, meant a lot of people were unemployed and didn't have access to money. So when aggregate demand shifts to the left, we refer to that as a recessionary gap, because we are in a recession in which high unemployment is created. If aggregate demand shifts to the right, we call that an inflationary gap, because that causes price levels to rise due to people spending more money. Now, we also know that through the circular flow model, money moves around between various parts of the economy. We've got households who buy goods and services that firms produce and sell. We also know that people sell their land, labor, and capital to businesses, and businesses purchase your labor in the factors of production market. So this circular flow model shows how money is being exchanged for products all around the U.S. economy, and then money can also be transferred from one government to another country. So if we look at this, we've got households and firms, and we also have the market for the factors of production, which are the inputs, and the markets for the goods and services, which are the outputs. So in the factors of production market, households are going to sell their land, labor, and capital. So you're going to go to a business, you're going to sell your labor, and they're going to use that as a factor of production or an input. In exchange for that, they're going to pay a wage. You typically refer to that as your income, even though it's the same money. So the green line here is the payment, and the red line is the good or service that you're being paid for. In the market for goods and services, households are going to spend their money. We refer to that as consumer spending. The business calls that money revenue. And in exchange, the firm creates goods and services and produces them and sells them to you. And households then, of course, buy those goods and services. And this keeps on going. Now, remember, money gets respent. So this green line, which started as consumer spending, the business calls that revenue. They use some of that revenue to pay wages to workers. Households refer to that as income, which you spend a part of in consumer spending. Money just keeps getting respent over and over again, hence the circular part of the circular flow. The things that are missing here, some that would be somewhere in the middle, is the government. Of course, the government taxes goods and services being sold. They tax your income, and they can also tax businesses' profits as well. And there's also banking institutions that should be in here, because remember, all of the income you earn, you don't have to spend that all. You can also save some of it. You can put it in a bank, you can buy a bond, or you can buy stocks as well. And of course, you can siphon some of that income off into the banking system. Now, how much of this money keeps circulating is dependent upon how much of our money we're spending. So this will create a multiplier effect as that money moves around the circular flow, but that is all dependent on the marginal propensity to consume. This is how much money, if you were given new extra income, how much of that new income are you likely to consume as opposed to spend? And the MPC is always a percentage in a decimal form. So if you got a new $100 in income that you weren't expecting, and you spend 80 of it, your MPC is 0.8. So MPC is basically your change in consumer spending over your change in new disposable income. Now, marginal propensity to save is the opposite portion of the money. So if you got $100 and you saved 20, your MPS would be 0.2 and your MPC would be 0.8. Marginal propensity to save is the same as 1 minus MPC. All right, so this creates the spending multiplier. This is a really important equation. This red box here is referred to as the spending multiplier. So 1 divided by 1 minus MPC. This red box equation is also the same as 1 divided by MPS. You would multiply that by the change in autonomous aggregate spending, which can be any type of new spending that goes on in the economy. You multiply those together and you get the change to Y, which is real GDP. So the spending multiplier, it gives you a factor by which the money is multiplied. You multiply that by the spending or tax cut, and you get a change to Y. So the multiplier effect basically means that that money is going to move around that circular flow multiple times. So if there's an influx in money, let's say the government decides to do a $100 billion increase, or we're going to do a bailout plan, or there's pandemic spending to try to increase the economy, that original influx of money is going to shift aggregate demand to the right. But when the money goes to businesses and consumers, it doesn't just get spent once and then saved all of a sudden. People spend that at businesses, the businesses re-spend it, and that's how we start to stimulate the economy again. So you get these secondary or multiplier increases in aggregate demand. Now, there is a downside to this, and the theory is called crowding out. That when the government, particularly Congress, uses expansionary fiscal policy to do a bunch of extra deficit spending, bailout plans and things like that, they're forcing aggregate demand to the right. The consequence is the interest rate effect, because when price levels go up, it will eventually cause the interest rate to rise. And remember, businesses need to get loans to do a lot of their spending. So as the interest rate goes up, investment spending drops, and that can be bad for business. This is referred to as the crowding out effect. So if the government is going in and spending a bunch of money, it's crowding out what would have been free market business spending. Here's how this looks. $100 billion increase in government spending, aggregate demand shifts to the right, but at the same time, it's going to cause money demand to rise, which makes interest rates go up. And as the interest rate rises, you're going to see a little kickback in aggregate demand. So our aggregate demand still rose from 81 to 83, but it didn't go up to 82 like it was expected to. In addition to the spending multiplier, you can also use that equation with the tax multiplier. This is what is used if we're reducing taxes instead of increasing spending or printing money to increase spending. Now, the tax multiplier is just slightly different, and it's always smaller than the spending multiplier. In fact, because people are basically just offsetting who's spending their money. If the government decides to give you a tax cut, it basically means instead of you giving your money to the government in taxes to spend, they're going to give it to you to spend. So there's still the same amount of money in the economy. It's just you're spending it instead of the government. So that is going to be a smaller multiplier effect than if the government actually prints new money and gives everybody in businesses extra money to spend. That would cause a larger multiplier. The tax multiplier is always going to be one less than the spending multiplier, and it's going to be equal to MPC divided by MPS. If the taxes are being cut, this would be a negative number. If the taxes are being raised, it would be positive. So we've already talked about fiscal policy, and it can be expansionary or it can be contractionary, depending upon what policymakers in Congress want to do to aggregate demand. And this is all based upon the government's budget. So the government makes their income typically through income taxes. They also tax the profits of businesses. And then if they still need to spend more money, after they have spent all the income tax money, then the government can borrow money, and this is what we sell bonds for. So the government will sell a U.S. government bond on the free market to anybody who wants to buy them. It could be a foreigner or it can be an American. And that means you would give the government money today, and the government would pay you an interest over time through the life of that particular bond. So to a person who is buying a bond is a form of savings, slow savings over time. But to the government, it's them borrowing money to spend today, but they pay interest later. Now, the government can also spend their money. They can spend it on transfer payments, which are payments that go out to people, let's say unemployment checks or pandemic payments. It can also be things like Social Security and Medicare. These types of programs are referred to as entitlement programs. From there are the major departments of the government, of which national defense is the largest budget outlay in the discretionary budget. The second biggest one is Veterans Administration. And then you've got all sorts of other parts that the government plays: transportation, education, housing, human services, and things. Now, remember, a cut in the tax rate not only gives workers more money in their pockets to spend, it can also incentivize people to work harder. If you think you're earning more money for doing a certain job, if you feel like you're being well paid, you're more likely to work harder to keep that job, because if you lose it, you might not get that same high rate of pay at a different workplace. So there are some theories that by lowering taxes, workers work harder. That makes productivity go up. These are people who believe in what's called supply side economics. So it's not that all government spending is the same. Government spending, of course, always shifts aggregate demand. But if you spend the money in the right way, it can also affect the supply line in the future, hence supply-siders. There's three main things that supply-siders believe the government, if it's going to spend money, should spend money on, and that is education, infrastructure, and innovation. These three things, if the government were to spend more money here, they would, increase aggregate demand, because government spending always increases aggregate demand. But these three things also increase aggregate supply in the long run. Every business needs educated workers. And if workers are more educated, businesses don't have to train them. Everybody can get jobs. Businesses and consumers use infrastructure. And of course, innovation and new ideas are also important. Congress can also write automatic stabilizers into the bills themselves that they're passing. An automatic stabilizer is just something that would automatically adjust payments or spending or budgets, so that policymakers don't have to go back and repass a law every time the economy changes. That would be really time consuming and very difficult to pass. So they put in an automatic stabilizer that would say, hey, if we drop into a recession and GDP falls by 2%, then we are going to cut taxes by a certain amount. And that would automatically happen. The other thing that happens in a recession is that more people now qualify for entitlement benefits like unemployment or welfare benefits. So if people's income drops, then you're going to need to spend more on certain things like unemployment. So these things automatically happen. They can also automatically trigger savings when the budget goes into surplus. I know that this is rare, but if the government doesn't spend what it brought in taxes, then you could automatically put that extra tax money into an account that earns interest as opposed to pays interest. There's also various types of inflation. So cost push inflation is when supply shifts to the left. That causes stagflation. We know that stagflation is both high price inflation and high unemployment. The type of inflation is called cost push, because it's an increase in input prices or input costs. There's also demand pull inflation. When demand increases, it causes an inflationary gap. We refer to that as demand pull inflation. And don't forget about our friend, the Phillips curve. The Phillips curve is just another way to show the trade-off between inflation and unemployment. And remember, it's a mirror image of your aggregate supply and demand graph. And the only thing that's different is that your horizontal axis is now unemployment rate as opposed to total employment. So it shows you everything else that's there. The short run Phillips curve is the same as the short run aggregate supply, but it's mirrored in the opposite direction. Long run Phillips curve is the same as long run aggregate supply. So if we have low aggregate demand and low inflation, like the graph here on the left, let's say that's a 3% inflation rate and 6% unemployment rate. And then, of course, we increase aggregate demand. That's going to make inflation rise. And here I put it up to 5%. It's also going to make your total employment rise, which is why Y goes up. So unemployment goes down. So your Phillips curve is downward sloping, where your short-run aggregate supply would be upward sloping. Phillips curve is shifted by the same things that affect your short-run aggregate supply. So this would be supply shocks. A supply shock is anything that is going to alter, your factors of production: land, labor, capital, technology, and entrepreneurship. We've used this example of an increase in oil prices that would cause stagflation. So a shift to the left here would cause prices to go up and output to drop. And so on your Phillips curve graph, you need to make both of those things happen. Your supply line shifted to the left, so your Phillips curve would shift out to the right in a mirror image here.